Siddharth Vora, who is a co-fund manager. So let's hear a round of introduction for Mr. Abhishek Gupta first. So he is having an experience of about nearly 2 decades in the equity investment area. Abhishek joined us from the Edelweiss Asset Management, where he was a senior portfolio manager, prior to which he was a member of the equity investment team at Goldman Sachs Asset Management. Abhishek has done his graduation from Sri Ram College of Commerce, post graduation from IIM Kolkata, and who is a CFA USA charter holder. Also, on the other hand, Siddharth Vora, who is a co-fund manager. Siddharth is a vice president equities, senior analyst within the team. Total experience of 12 years in the equity investment area, who is a part of HSBC L&T team for last 3 years and a mix of 7 years in buy side and 5 years in sell side, covering multiple sectors such as IT services, internet technology, auto and ancillaries, metal and cement. Prior experience at the Reliance Nippon Life Insurance, Motilal Oswal Securities, BNK Securities. Siddharth is an engineer in IT from DJ Sangvi, Mumbai, and post-graduation done from Wellinger Institute of Management, and who is also a CFA and charter holder. So yes, we have two interesting personalities sharing the common goal. So today our web call will be based on their upcoming NFO HSBC India Export Opportunities Fund. So let's hear their journey through them. Over to you. Thank you.
Thanks, Disha, for the introduction. Uh, just please make sure that my audio quality is consistent. Otherwise, let me know. I'll probably will have to switch off my camera just to make sure that the bandwidth allocation is not a problem.
Abhishek,
Uh,
you're perfectly audible.
Perfect, great. So let's just start with the agenda today. So clearly, I think we all are going to discuss the upcoming NFO, which is already up for applications and investments. It's called HSBC India Export Opportunity Fund. What I'll do, and given Siddharth is also here, and trust me, he speaks and he sounds more convincing than me. So I'll let him do most of the talking. But from the perspective of just kind of sharing you some thoughts that exactly what led to this ideation, because I get asked this question a lot that given how India as one of the fastest growing economy in terms of the larger economies, and domestically we are hearing so many positive news flows, and again there are sectors which are doing so well. So what led us to evaluate export as an orientation today? More importantly, in the context that everyone is kind of little jittery in terms of how the global market is looking like. So let me just kind of start with the ideation part, and then we'll follow through with some of the data point to probably convince you that we see this as a huge opportunity from a wealth creation perspective. So typically, just like any other post-quarterly exercise, we were kind of just rumbling through the management transcripts, commentary, and the con call transcript post last quarter's results over the case of this quarter result. We kind of realized that if we talk specifically about export-oriented sectors, be it textile, be it chemical, be it technology, we kind of heard something which we haven't heard in last 4 quarters, which is they all started sounding more optimistic than what you've heard them in last 4 quarters. They started giving you reasons like the client is back to discussion table where discretionary spends were put on hold. Wherever there were concerns on excess inventory, given now the inventories have not been cleared, they are back to normal inventory level, which means the restocking shall commence. Wherever there were concerns, either because of high energy prices or the logistical issues, they have been to a great extent taken care of. Net net, you saw more optimism coming out from export oriented industries. We didn't just want to rely on few management commentary. So what we did, we went and looked at some of the data which is published by World Bank. Luckily, they also corroborated the same fact because again, if you go by World Bank's projections and they do the projections on the economic outlook for the major economies, since 2021 post COVID, most of these developed economies have been facing their share of issue for whatever I enumerated earlier. And if you go by last year, which is 2023, there were five major economies in the world, which is your UK, Germany, Saudi, Argentina, and Norway, which was still in deceleration or a recessionary mode. Talk about 2024, out of those five, only two would be, or rather expected to be, in a deceleration mode. And next year, none is projected to be in deceleration mode as per World Bank projections. So clearly, we can again see a trend emerging here that probably the worst of the downturn or the bad news is in the price. We are seeing some tapering off, and maybe the gradient of recovery, nobody knows at what clip and what pace the recovery can play out. But it's kind of giving us the comfort that maybe we're looking at the bottom of the world economy also. Last but not the least, clearly, I think the impetus or the focus which is being given by government towards focusing on exports, taking this from 22% of GDP today to 29% of GDP by end of this decade, is something again which gave us a lot of confidence. Because again, I was just reflecting back. If you think about wherever this government has kind of focused in last 3 to 4 years, whether it is specifically towards defense, incrementally talking about shipbuilding, even if you talk about PLI as a scheme, or you talk about overall PSU culture, which they have been trying to improve. Almost everything what they have done touched is like a Midas touch. Everything has turned into gold. So we believe even that government is now focusing a lot in terms of the overall impetus, bringing India to the global value chain, bringing India's manufacturing might to the fore, and related activities around that clearly gave us a strong confidence factor that maybe export is a space to evaluate. Here I will hold on. I'll let Siddharth run through a few of the very interesting deck which we have in terms of data and slide. We will take you through again our understanding on why this sector is looking so bright for growth. And then I'll come back in the later part of the discussion about the portfolio construction, and then we'll open it for Q&A. Siddharth, over to you.
Sure. Thanks, Abhishek. Hopefully, I'm audible loud and clear to everyone. What I'll do is
Yes,
I'll
very
share
well.
the, yeah. So, yeah. So, yes, as Abhishek pointed out, we have started to get a lot convinced that the India's export opportunities are the thing to look at in the next 6 to 10 years. There is a top-down theme which is playing where we want to add our bottoms-up expertise. What we'll do is, so we start with this slide. Now, this is our start top to down slide where the first aspect in India's nominal GDP being at $3.6 trillion, getting doubled by 2030. So when you see this 3.6 by 23 going to 7 trillion by 2030, what this basically means is 2x in 7 years. That is a 10% growth. A 10% CAGR growth is more or less split between a 6 to 7% real growth and 3 to 4% in terms of inflation. I would say this is largely accepted by a lot of agencies globally. This is a number put forward by RBI, and the numbers below that are put by Ministry of Commerce and Industry as well. So while this nominal GDP aspect is somewhere being said that yes, India is poised to do something like this in the next 7 years in terms of doubling of GDP, what the second layer of that many would have not known is India's exports currently stand around $780 billion. That the government is focused on doubling it to $2 trillion. When you look at the export overall market, that can be split into two. One is product, which is product, goods, merchandise, and the second is services. Both the segments are expected to be around $1 trillion each and expected to grow faster than the GDP rate of 2x. We are talking about 2.9x in the services side and 2.2x on the product side. When you think of this, this is a main slide of sorts in terms of how we are thinking. India is currently sitting over here, 2023, $3.6 trillion. When we say 3.6 going to $7 trillion by 2030, there is a World Bank estimate number which says by 2029, India will become the third largest GDP globally. When you think of it that way, in the last 20 years, we have come from number 12 to number 5, and the next journey is happening from 5 to number 3. If you see this part, where 12 to number 5, it was largely driven by domestic demand. Our entire demographic dividend, the kind of population we have, the kind of demand it generates. At the same time, it was somewhere our current government's focus as well between 2003 and 2013, where we used to give out a lot of funds at the hand of the consumer. It can be in the form of incentives, subsidies, etc. Now, the fact is, when you are going from number 5 to 3, look at the countries above us: United States, China, Germany, Japan. All these four are largest exporters in the world. China is sitting at $3.5 trillion. United States is $2.9 trillion. Germany is $2.1 trillion. Japan is 917 billion. If you look at the ones below us, United Kingdom and France, which we have leapfrogged very recently, those names are also around the $1 trillion. So, what the fact we want to highlight over here is this journey of starting to be the top five economies in the world globally always comes with the fact that you are large exporters as well. Otherwise, to have that kind of a stature globally is a bit difficult. All these countries above us have gone through that phase where their exports have surged quite a bit, and after that, they have created a steady state of wealth within their country, a steady state of GDP per capita income as well, that now they are large demand driven in terms of economy. Let's see a classic example of this. China was at number 6 in 2003. Between 10 years, 2006, 3 to 2013, 6 went to number 2. The fact to notice over here is China's goods export over here was at $450 billion. The last slide I showed you, India is sitting at $440 billion in terms of goods export. Somewhere you can say India right now is 20 years behind China. Now, this fact is that when China went from number 6 to number 2, the entire export story went up so much. You saw $450 billion of export going to almost 1.65 trillion by 2010 and 3.35 trillion by 2013, and their number went from 6 to number 2. So that is the kind of multiplication they saw between 2003 to 2013, where their numbers in the next 7 years went up almost 4x and almost 7 to 8x in the 10 years. What we are targeting in our previous slides is 2.5x. When you see this broader information, then it starts to sink in that yes, 2.5x is not a large number. Somewhere you can do even better than that. So that is where our conviction comes in, that now India is going to that stage that among the top five economies globally, our exports have to start to rise. And when we start to dig deeper around this, we see a lot of plus points which help improve our faith better in terms of this scenario as well, that yes, exports opportunities are going to be large and they are going to turn out in the next 7 to 10 years. Let's see the first aspect. How closely linked is economic growth with GDP? So some countries like China, Japan, United Kingdom, large developed countries have seen a very close correlation between their exports and their GDP growth. So this is nominal GDP growth rate in dollar terms, 16%, 17%. This is the kind of number China has seen between 94 and 2014. For China, it has been 15% GDP growth, 10% exports growth. So this was their phase in terms of 85 to 95. United Kingdom also has seen a very close correlation in terms of their nominal GDP growth and their export growth rates. What we would like to focus is look at the India situation over here. In 2002 to 2007, our GDP grew at a very handsome rate at 19% in nominal terms. The export story of it was even stronger. It was at 28%. At the same time, between 2007 to 2023, which is a very fairly longish period of 16 years, this number was around 7% for both GDP and exports. Mind you, this is in nominal terms, but it is in nominal dollar terms. If you look at it in INR, this number was somewhere around 12%. What are we stating in terms of our first slide? We are stating that the GDP expectation is 10% in the next 7 years. At the same time, the export number is as high as 14%. What we like to call it over here is the 1.4x converter. When you are trying to play the entire export theme for India, you are probably playing the 1.4x converter of nominal GDP of India. So that is where we are focusing on. We'll tell you various factors as well, which will help you further in terms of getting convinced. So the first aspect, when you look at exports, it is a part of the broader basket of forex reserves. This government has been really focused on maintaining a healthy forex reserve. Back in 2012 to 2014, when our forex cover, that is the months of import bill, fell below 8 months, it was around 7.1, 7.0, 7.8. Our currency depreciated from 45 to 65, almost 50%. That is the kind of depreciation we saw in that phase of those 3 years. And the government is very aware of that fact that they need to maintain a healthy forex balance and make sure that they have a stable currency, because at the same time we have a very large import bill. What does it come from? That import bill is sizable for petroleum and petroleum basket and coal, which is around 30 to 35%. At the same time, gold and gemstones are also around 20% plus. So when you look at those numbers, those are not much under government's control. They can't do much about it. They will go as per their demand trends. So rather on trying to reduce or control imports, this government has been consciously working on improving our entire export scenario, so that things automatically fall in place. When you see over here, in 2018-19, our number was 425, that has gone up to as high as 671 in terms of now, and we've seen a steady improvement in this scenario. Now, the second aspect is exports. When you look at exports, post 2006, 2005-6, we have hit the 20% mark broadly. And since then, for 2006 to 2024, in FI terms, that's largely for 17 to 18 years, you are around that 20% mark, plus or minus 3%. When you see it goes as low as 18% or even as high as 25%. So 20% has been the contribution to our GDP from exports. And that is why we tend to say that we are going to build a portfolio where 20% plus revenues comes from outside India, then that is eligible for our fund. So that this chart is the underlying theme on which we are building that 20% of our GDP is coming from exports. At the same time, when you see this numbers 534 to 783, that growth is 10% in the last 5 years. That 10% is in terms of GDP terms, it was 6% and export was 10%. So that multiple over there as well, it is 1.7x. We are trying to look at 1.4x in the coming 7 years. So yes, in the last 5 years, we've started to see that improvement in terms of India seeing that entire export vector playing out. Now, in terms of our exports, those are obviously split into two, the merchandise side of it and services side of it. Services has always been the faster growing segment between the two. It has been almost 4% plus since 2001 as well, or in the last 5 years between 20 to 24 as well, the differential has been as high as 4%. So services is India's success story in terms of exports. That is where the entire IT sector has come in, the entire GCC sector has come in, and we've done really well. So when we look at this, India has been the third fastest services export country between 2005 to 23. The growth rate is as high as 11%. Look at the two countries above us. That's Ireland and Singapore. Those are basically small countries, trade centers, not really our competition. But even with that, their differential to us is as high. We are at around 11%. Those are probably at 11.5 to 11.7 kind of a number. So the difference is also not that big. At the same time, their sizes are very different to us. So India's success story has been the services export story in the last 18 years. That is why you see over here that we have 4.3% share in terms of global services market. At the same time, global merchandise exports, it is as low as 1.8%. Put that into consideration that the goods export market is $23.8 trillion, almost $24 trillion, versus the services market is at $8 trillion, 7.9. So there is a 3x multiplier which works in the goods market. And I will say we've not done much in terms of the goods market over the years. Services has been our segment where we have made rapid strides. So this is a second beneficiary of the services export story. We see what we try to highlight is the entire GCC story, which is the global captive centers, where it all started in 2010. All the companies globally, MNCs, started to look India as their back office because the cost situation in India was much better and things getting done over here was much more profitable for them. But when you look at it between the last 13 years, from 2010 to 2013, it has risen over in terms of the value chain. Today, you see a lot of product development, innovation, research, cost efficiency oriented measures, everything is happening in India. There is a lot of experimentation which is also happening in India. So we've really moved up the value chain. At the same time, look at the kind of GCC talent. It is 16.5 lakh per year. Units are 2740 plus. The next 5 year, the estimate over year is as high as GCC talent is going to go 34 lakhs and units are going to be 3200 plus. What basically it tells us this India is getting integrated into global supply chain. We have a lot of companies, be it banks, software, technology, capital goods, industrial, everyone's are coming over here and setting up their GCC centers. We now know how they operate, how they think, how they innovate. So that is why when you see over here as well, engineering research and development, the 10 billion number in FY15 has gone to as high as 26 billion in FY23. And it's expected to grow at a much faster rate than the information technology or the BPO segment. So that is where we say that GCC is actually a success story of services, which is creating the manpower we will utilize in our entire manufacturing journey going forward in the next 7 to 10 years. When you see the good side of it, let's see what has happened for India between 2004 to 2023, which is roughly around 19 to 20 years. India has seen the market share improvement around 1%. Between 2015 to 23, it has been as low as 0.2%. Where we have gained, it is machinery, electronics, autos. Where we have lost is in the textile and clothing segment of negative 0.9. I will fairly agree with you if you say that in the last 8 years, we've not done much in terms of exports. Some segments have been up, some segments have been down. What you need to focus is over in the China part of it. Between 2004 to 23, China went from 6.5 to 14.1, but they had already reached 13.9 in 2015. The difference is only 0.2 in the last 8 years, very similar to us. This is where the impact of moving away from China, looking at alternatives to China, has already started to play out. You've seen electronics seeing a dip, textile and clothing has also seen a dip. Probably in autos, they've done well because of the entire EV market share which they are gaining globally. But yes, the overall export share of China is also starting to plateau out. And that is where we say that at our base of 1.8%, we are poised to now improve from this levels. When you look at the several categories, chemical has gone from 5 to 7%, machinery has gone from 5 to 10% almost. You have drugs, optical, medical, and surgical instruments, basically healthcare and devices, has gone from 5 to 7%. Similar is the number on the electronic side of it, where 2% has gone to almost 7% kind of a number. So India is seeing surging of export market share on multiple categories. We are seeing rapid improvement. When you see the manufacturing export growth drivers as well, there was a report put out by Bain Analysis back in August 22, where the fact was that the textile and apparel segment, the segment where we were losing share and not focused at, that is also growing as much as 13 to 16% for India. These numbers are for between FY22 to 28. If you think of the segments above that, which are our sunrise sectors where we are really focused on automotive, electrical, electronics, industry, machinery, pharma, chemical, the growth rates are very healthy. It is upwards of 15%, going as high as 35 to 40%. So in this scenario, when you look at this kind of estimates, what we are targeting, we are at 14%. If you look at the right scenarios, I think 14% is quite easily achievable. When you put these numbers together, total all this right hand side up, you go to somewhere around $600 billion of the $1 trillion opportunity we are targeting. That is coming by FY28 according to them. We are looking at 2030 kind of a number. So the estimates for us, in our view, is not somewhere stretched. It is something which is poised to happen. At the same time, there are levers where it can be even better than that. When you look at the government policy initiatives, we have already started to make a lot of strides in terms of telecom equipment, electronics, auto parts, advanced batteries, pharmaceutical drugs, glassware, ceramic, automobile, solar energy components. So there are a lot of sunrise sectors which is coming across. The government is focusing on adding new verticals. They are on the ground, hearing out in terms of where are the opportunities and what they can do in terms of improving our export opportunities or putting up India as a manufacturing base. Now, why the export theme right now? and why we need to play it. There are four big factors around it. One is the leadership in terms of labor, both cost and skilling. What I like to say, it is skill at the right cost. We have all kinds of skill, but the cost at which it is available in India, it's the most competitive globally. We have government policies as well. Government is working silently in the background in terms of reforms and incentives, be it in terms of production centric reforms. They started from Make in India, went to Atmanirbhar Bharat. Now it is in PLI, which is in its most massive form, which is benefiting a lot of sectors out there. Look at this side, which is also benefiting us a lot, the geopolitics and supply chain diversification. What has happened in the last 5 years, be it COVID, Russia Ukraine crisis, or recent Israel Hamas? People have started to see that in their global trades, there is significant concentrations which lie in China, which lie in Russia, be it Israel. Is there a bit of it in the Middle East as well, where Iran is a large part of it? And they want to create alternatives. They have to create alternatives because such outcomes can be quite frequent in the future as well, and they want to move away from them. So this entire geopolitics and supply chain diversification is also playing in our favor. At the same time, this government has done one very good aspect, is reached out to so many countries globally that now we are looked at as a preferred working partner or a preferred country across the board, across countries globally. And many people look at us in terms of their global future plans because we have the talent, we have the policies, we have the entire geopolitics which is working in our favor. Now, at the same time, we are going up the value chain from cost arbitrage to value added solutions as well. Even if you want to do research and development, do innovation or pure experimentation, to set up centers in India, it is easy. To wind down centers in India is also really easy compared to what it is in US and Europe. When you look at our labor advantage, it's a standout in terms of the working age population by education. When you see the basic or less than basic number, it is sizable. It is even bigger than China. Intermediate and advanced also, we have a sizable number over here. Our average age of working population is around 28 years. We are only going to 30 years in the next by 2030. Compare that to someone like a China or a US, they are almost hitting 40, 42 plus. So their numbers are going to be way higher. We have the largest working age population, which puts it in a sweet spot. What China you are seeing in terms of the average monthly earning is much higher than us, around the $1,000 mark. They were sitting at our levels. We are currently at a $150 number. They were near a number of 150 to 200 back in 2003, 4, when you saw that surge between 2003 to 2013. But once that has been done, they have gone through that entire phase of economic development. Their per capita income has also gone up, and the average wage cost is no longer that lucrative in China. When you look at the aspect of moving up the value chain, it is a nominal scenario for any economy which looks at exports. It starts with consumer goods and then it graduates towards the capital goods aspect. It's a simple photographic over here, which you see that you normally start with garments, that is textile, then it graduates to something like a steel, television, laptops, semiconductors. We are actually moving in that phase where we are entering the capital goods scenario where exports are starting to pick up in all these categories for India as well. Now, the reforms and policies aspect. What I like to say over here is this government, while they have been focused on putting the manufacturing center in India since 2014-15, they have been diligently putting out policies, multiple in place. At the same time, they also know that it is something which is going to take time. It is not going to happen in a span of 3 to 5 years. They will have to consistently work on it in terms of the various factors which cause this to happen. The first factor in this scenario is as good as the free trade agreements, FTAs. This government has signed 14 free trade agreements in the last 5 years. That has covered almost 26% of our trade, which is free of any taxes. They are further working on 9 free trade agreements, which expands that trade number from 26% to 76%. So there are significant policy related initiatives which they are working on. They have rationalized the various taxation aspect as well. If you have to put up any manufacturing setup in India, it can be done as low as 15% taxation. Over a period of time, it goes to as high as 25%, which is competitive globally as well. You look at the various other aspects, promote districts at exports hub, you get single window clearances, you have production link incentives, If any MNC wants to come and set up in India, they are given the green carpet treatment. So what we see is aligning of various factors coming together in terms of how things are going to shape up and exports going to go up. The one aspect where people tend to be worried, they tend to think that the global recession is an area where there will be a big hit for us in terms of their export market. What we have seen historically as well, that India's export market share is so small in its absolute number. We've only seen expansion in market share over the past history. It has never gone down. In absolute terms, maybe it goes down during recessionary periods, but it never goes as much below as the overall market goes down. We always end up gaining market share. At the same time, always remember that Indian exports tend to be always cost effective. So whenever there is a scenario of recession, the exports are actually seen positively where there is a bit of shift which happens to India because of our cost effective nature. Now, the HSBC Export Opportunities Fund, I know the fund specific, Abhishek will take into details. What I like to show forward is some of few case studies. So look at this. Where are we trying to focus on something like this kind of a theme? Let's see this case study. So there is this surge in global renewables demand. So what is happening is many Western countries, Europe, US, are trying to integrate various sources of energy, be it solar, nuclear, wind, even battery storage, hydro, thermal, everything together in terms of their power grid infrastructure, and it is going through a massive rehaul and upgradation. If you see in this, what is a big requirement? It's the global conductors market. Where what are these conductors? These conductors are basically wires joining the large towers which you see on the highways across countries. It is basically the entire electricity infrastructure which you have to put up within a nation. In this segment, China was the leader back in 2012. It was around 22%. India was as low as 10%. That number for China went to as high as 40% by 2017. The fact to notice over here, from 2017 to 2023, that number has come down to almost 20%. And India has gone from 10% to something as high as 25%. We are now the leader in global conductor exports. The bigger fact is what happened in this background in the last 6 years, that India surged from 10% to 25%. What was actually the scenario was that all these countries in the Western markets knew that they were making their grid for the next 15, 20 years or even more than that. They were rehauling their core infrastructure. If sizable part of imports were coming from China, there were concerns around security, around spying, around access to their core infrastructure to China, which somewhere they had questions around. So they started to move away from China. And you see this, that entire aspect from 2017 to 23, plummeting of Chinese exports and their market share, and India gaining. A company which operates in this segment saw their export revenues go up as high as 27% between FY17 to 24, and their stock prices went up by 18x since December 15. If you put that number over here in terms of December 21 as well, they're probably 9 to 10x in this phase itself in the last 4 to 5 years. So this is the kind of wealth creation opportunity we are running behind. If you have a construct on a portfolio basis which focuses on the various export opportunities, you will have a chance that you hit some options like this within your portfolio where there is strong wealth creation scenarios. If this is the good side of it, let's see a services side of an example. If you look at the global auto ER&D, which is engineering and R&D services spent, it is can be split into two. One is the legacy portion of it, and one is the digital. What is legacy? Legacy is basically the age-old spend which was being done around our ICE engines, which is more like petrol, diesel, gas. If you see the above spend, which is the digital engineering spend, this is basically which has come about with the advent of Tesla. You have a lot of screens, lot of connectivity, electronics, processing power, which has come into within the automobile. So that is where people say this case spends, connected, autonomous, shared, electric. That has started to balloon like anything. It has gone up 21% between 21 to 22 and expected to go up 15% from 22 to 26. A company which works in this domain from FY19 to 24, the revenues have gone up from 275 to 600, almost over there. margins have gone from 11% to 20%. Stock price has gone up as high as 16% in the last 16x in the last 5 years. So these are the kind of opportunities we are running behind, which we want to have in our portfolio, and that is why the portfolio construct which we have made over here. So portfolio construct in terms of Abhishek, you want to take it over? I can continue this as well.
No, carry on, Siddharth. If I have to add
Yeah,
something, I'll add after you.
perfect. So see the scenario as I showed in the start of it, that our exports are around the 20% mark, plus or minus 2%. And that is the metric which we have gone after, and that is why we've put revenues greater than 20% from outside India as the filter which we'll put on a portfolio basis. What we have done is basically found out a universe of sorts. It's a universe of 310 companies currently. This is from a total number of 1040 companies, above 2000 crore market cap. This 2000 crore market cap is also as per SEBI norms, which is on an average market cap basis for 6 monthly period up till June 30, 2024. On that 1040, we found 310 companies. It's a wide split. Goods are 235, services are 75, around large, mid, and small as well. Large cap companies are around 31, mid cap 40, small cap around 239. So it's a fairly wide split in terms of market caps as well, in terms of segments as well. What will be there in the portfolio in sizable terms? You will have all these verticals: auto, components, textile, IT services, electric equipment, construction, transport, logistics, pharma, biotech, petroleum, telecom, metals, industrial, healthcare, chemicals, agri. So what people tend to have in their mind that it's an export fund, it will be largely IT and healthcare. That is not the case. We are trying to play the export opportunities fund, where we'll be looking at companies who are doing around 20% plus only currently in terms of their portfolio, in terms of their revenues. But they have this potential opportunity that 20 goes to 25, 30, 35. And the kind of surge which it brings about in their profitability, in terms of their return ratios, and in terms of their valuation multiples is what we are targeting. Now, these are the large segments. If you look, when we looked at our universe, what we have come to conclusion of sorts was that IT services is sizable wealth creation opportunities over here. So roughly around 20% comes over here. But there will be 5, 6 verticals which can be 10% each. These are auto, construction, electrical equipment, petroleum, telecom, metals, industrial, manufacturing, healthcare. So you will have a spread of verticals, you will have spread of market cap as well. We are targeting around 50% from large cap, plus or minus 10%. Mid cap and small cap are 25% each. So it's a multi cap kind of a portfolio where you have what is a stability of large cap companies, at the same time opportunities which you get from mid and small cap as well. But it's a differentiated multi cap. When you see it over here, it is a lot of sectors which will be there, a part of your normal multi-cap fund are not there over here. Banks are not going to be present. Capital markets, cement, finance, gas, insurance, power, realty, retail as well. So these sectors right now, we didn't find many companies which will be doing 20% plus outside India revenues, and that is why this what segments will not be a part of the fund in sizable terms. You will have 80% of the fund coming from purely from the theme. So roughly 80%, so around 83, 85% comes from the theme to be more compliant for the day-to-day M2M norms. The rest 10%, we have an opportunity to play where we can do multiple aspects. We can play at companies which are not 20% right now, but which can be 20 to 30% in the next 3 years because of the various plans, any orders, capex, or something. At the same time, we can also play it purely something which is not there in the theme, but it is high conviction for us. But that will be more like 2 to 3%, not more than that in terms of its size. So this is where we have said that the kind of portfolio we are trying to construct, it's more revolving around export opportunities. It is not just exports. You will have some companies around 80, 90% exports, some companies around 20, 30, 40% as exports. So broader number has to be around in that 40, 50 mark, how things stand as of now. So yes, that's the broader construct on which we are working on in terms of this. I have further case studies as well. Those are expected to do. So something like specialty chemicals, IT services, what we like to highlight over here is it's a different example. People tend to quiz us that your entire export story or the manufacturing in India story is dependent on the PLI scheme. If PLI is stopped tomorrow morning, then it goes away. What we like to say is it always happens that way. The government focuses on segments, it provides support to them for the first 10 to 12 years, and then there are big wealth creation which happens. Look at the IT sector itself. It was a $1 billion market in FY97. Today it is $200 billion IT services exports. How did it all started? It started in 1990s with an STPI scheme, Software Technology Park of India. What all benefits you get: 100% foreign equity participation, no geography restriction, duty-free imports, 5-year block of tax holiday, exemption from domestic levies. So this was the kind of support these guys got in the first 8 to 10 years, and from there was no looking back, and it went on its merry way. That is what we are saying over here as well. This government is focused on putting up India as the manufacturing hub globally. It will be first for in terms of replacing imports as well as import substitution, and then eventually creating muscle that you will be able to do exports as well in the broader story. So that is the kind of opportunity we are working on. What we see is that when you try and pick companies who will benefit from this entire transition to a higher exporting nation, exporting country, sorry, company as well, then you will see a lot of improvements in terms of margin, returns, and at the same time, the valuations also play in favor of you right now. Otherwise, if you look at something like peers as well, let's see if the fund peers which we have a peer which people try to put across to us in terms of ICICI. So these are export of goods and domestic services. It's not really a peer to us. They have a number of 50% plus as the revenue number. That is what we trying to put across. When you say 50% plus, means mostly the story has played out. The wealth creation has already been done. It's more like a cracker story. We are focusing at 20% plus because we want to look at opportunities in the mid and small cap side, which can have differentiated picks and strong wealth creation in terms of what the portfolio can do in the next 5 to 7 years. That is where our focus is. It's a differentiated theme. It is one of its kind. We expect more people to follow us. There have been things in the past as well where we have been early. So look at over here. The multi-cap fund started in 30th June 23. The consumption fund was last year August. We've seen many people follow us. The export opportunities fund is also a segment where we see others will come to us because it's an opportunity we'll play across in the next 5 to 7 years. It is multi-cap in nature, multi-vertical in nature. There is no concentration as such. It is much more diversified. It can give you stable returns, which are like 1.4x your benchmark. Our benchmark are Nifty 500. This Nifty 500 benchmark is basically because we don't have any realistic benchmark which can reflect our fund. But at the same time, it is the benchmark which we are aiming to beat. How much? So 1.2x to 1.4x benchmark returns is what we are looking at because the nominal GDP is pointed out by Nifty 500. We are looking at export opportunities. So we do better than Nifty 500 by 1.2x to 1.5x. That is our aim in terms of what we are working towards. So broadly, that I will put that concludes from my end. Any confusions, any doubts around various facets of it, will be happy to answer.
Thanks, Siddharth. Disha, we are open for questions if you guys have any.
Yes, thank you. Thank you so much once again, Abhishek and Siddharth, for a wonderful presentation. So I'm sure all our partners have got their takeaways from this presentation. So I would like to display the first question on the screen. So moving to our next segment, Q&A. Give me a- Yeah, is my question visible to you?
Disha, I can't hear you. Is it just me or others also can't hear you?
I can hear.
Yeah,
It's
okay.
better now, yes.
Okay, yeah, thank you. So I'll just read out the question for everybody's convenience. So, how can export impact nation's economic growth? I think you have broadly covered in one of your slides, but still, if you would throw some light on the same.
I think as Siddharth alluded, clearly exports has, in my mind, to simplify it, how I see it, just like when we travel in aircraft, we need twin engine to fire. to take us from point A to point B, right? Similarly, if India has to go the path of Viksit Bharat by 2047, it just can't be totally relying only on domestic opportunity. It has to be domestic and export to an engine to fire to take us from point A to point B. We have alluded to the fact that you look at from an export perspective, there's so many advantages it brings to a economic progression of a country. In my mind, it is not a question of either or. It is a must to achieve your true potential. Let's start about few of the aspects, right? So we can talk about it incrementally creates more economic opportunity on the sake of creating more employment opportunity overall. It creates, as we highlighted, your overall forex reserve, which brings stability to your currency. It incrementally leads to more innovation because again, understand you are now competing with the best in the world. So unless you imbibe the best of the technology and cost advantage, you cannot compete. So it brings innovation inwardly. Typically, we have seen companies which are more export oriented typically enjoy a better return profile at a business level. So that also again helps in terms of gaining that economic benefit when you invest in a company which is focused towards that. Last but not the least, I think as we mentioned, as you gain more on export front, you as a nation become more visible at the overall global scale. It brings you to the reckoning, and in that process, you're also able to utilize your excess capacity, which would have been otherwise lying idle. So I think there are numerous aspects about export, what they bring to the nation's economic progress and growth, and hence we believe export is a must rather than a choice.
Yes, absolutely. Thank you. Thank you for the brief answer. Moving to next. So, how is India positioned in terms of export?
Yeah, so again, I think Siddharth did touch upon these
Yes,
aspects, but
yes,
to
yes,
again
absolutely.
re-encapsulate, today India has about 4.3% market share in the global services market. If you look at on absolute services, we are ranked between fifth to seventh when it comes to the size of our services export. Now, coincidentally, India is also fifth largest economy in the world, as we discussed, and India's representation in the global GDP is about 5.4%. So in our understanding, India is equally or fairly represented on the services side. We are not over-indexed. Where we are under-indexed today is the merchandise side, where India has about 1.8% market share, and we are the 17th largest nation in terms of absolute merchandise export, while we are the fifth largest economy in the world. So clearly, there is a lot which needs to be done on the merchandise side. And if you look at from an overall perspective, we have about 2.3% market share on both goods and services combined. So that is how India is today positioned when you look at the overall export opportunity and how we are capturing it.
Yes, thank you. Thank you for clarifying that. So, moving to next, which are the major emerging theme under export?
So that's my favorite question because then I ask the question in reverse. Tell me what are the
Mhm.
themes you would have been bullish in last 18 months? If I can enumerate few, we have heard a lot of positivity around auto ancillary. We have heard a lot of positivity around innovation. We have heard positivity around manufacturing, around defense. So if you kind of think about these and energy, right? These are the five themes. I'm sure you guys would have also heard a lot of sectoral funds launching around these themes. Now, if you think about export, in my mind, it's an umbrella product. All these themes which I mentioned will be part of this portfolio. So that's a very important aspect to be mindful of, and that's why we are re-emphasizing again and again. It is not a concentrated theme product. We don't have a constraint in terms of number of name on universe to day one. We are starting with 310 names eligible to be part of this portfolio on day one. Trust me, this number will only keep expanding. To again give you some anecdotal data around that. In 2013, the same number would have been 187 companies which would have qualified for this portfolio. Today, as I run this portfolio, we have 310. Given the incremental focus which the government is putting on exports, I think very clearly by 2030, this number will possibly be touching forward or even more. So, first of all, it's a well umbrella diversified portfolio which gives you opportunity across the themes. But as Siddharth mentioned, if you have to talk about few of the sectors which we see as in day to day, which would be fairly represented in this portfolio. So obviously technology is a part of it. Pharmaceutical healthcare would be important. Auto ancillary would be important. Capital engineering goods would be an important opportunity. Chemicals, textile would be another important segment. Petchem exports would be another opportunity. Incrementally, government is working towards clean tech energy, so that will be another opportunity to play at. Defense exports is not sizable enough, but will still have a fair representation because eventually it will become big enough. That's another theme which we'll be focusing on. you will be surprised that even on the consumer staple side, there are already 10, 12 companies from India which are doing more than 20% exports revenue. So maybe if we want to capture the discretionary spends coming back after inflation being tame across the globe, that will again be an exposure for us. So I think the opportunities are just far and numerous. Rather than enumerating what we will include, it's easier to tell you that the financial part of the sector, which is typically overexposed for any diversified strategy, is where we will have a underrepresentation. And again, I want to highlight this point very importantly. So, underrepresentation of BFSI is just not by design because it does not qualify for 20% export revenue, but it's also by choice. So, if you look at our portfolios, HSBC equity portfolios, any scheme, we have a more conservative assessment of BFSI going forward as an opportunity. So, again, luckily, this is a strategy which by design and by construct gives us freedom to move away from a sector where we have a more conservative assessment and redeploy that capital towards a higher growth phase opportunity.
Okay. Yes. Thank you. Thank you so much once again for the detailed explanation. So, yes, moving to next. What are the manufacturing export growth drivers?
I think when it comes to export opportunity, right, and that's why Siddharth alluded to this, that
Yes.
we are looking at PLI as a very strong contributor to this whole manufacturing story in India. Again, to put some number in context, today manufacturing represents about 15% of India's GDP. If you go by government's projection, they want it to be 20% by end of this decade. Now, within that, clearly, if you talk about PLI itself, there are about 14 sectors which are right now working towards manufacturing as an opportunity under PLI. Cumulatively, they are going to spend about 4.5 lakh crores, of which 50% will be sponsored by government. The remaining will come from the companies themselves, which will generate incremental potential of 3.5% GDP once these capacities become operational. So I think drivers are very evident. You create first import substitution. It's like testing your capability at home ground. You understand the nuances which you need to work on before you compete at the world scale at large. When it comes to the export growth levers, I think clearly the size, the scale, the technological advancement which we will see. So just put a number here, right? Talk about Apple, and generally why I bring Apple here is because Apple as a company is focused too much on value addition, aesthetics, and quality of product. They don't come to India only because India is offering a $5-10 cheaper product. If you look at today, every 1 in 7th iPhone is made manufactured in India. And if you go by projections, in a matter of next 2 to 3 years, every 1 in 3rd iPhone which will be made in the world will be manufactured in India. So I think clearly moving up the value curve, using the skill set, incrementally creating large capacities of size, scale. These are the drivers which will pull India on a global manufacturing export footprint.
Yeah. Thank you so much. So, moving to next, what are the different deglobalization trends visible globally which may impact export equations?
So if I understand this, this is more to understand that given there are a lot of noise around nationalism, how would that impact the opportunity when it comes to Indian companies, right?
Yes, yes.
Understood. Okay. So yeah, I think clearly it is something, and if you see again the data which showed you that China's incremental market share gain tapered off after 2014, even if you look on a global export base. So clearly, at a country level, right? I mean, first of all, the fact that COVID, and I say this, COVID was a watershed year. I think practically the world trade environment has changed before, prior to COVID and post COVID. If prior to COVID, you just wanted to diversify your supply chain to make sure that you are looking at more alternatives, post COVID, you even wanted to understand and you wanted to work with nations which were seen more friendly, which was seen where you did not have a concern about your sovereignty, security, and maybe you wanted to work again with the partners which were seen more neutral or friendly rather than belligerent nations. Now, in that context, clearly every nation want to at some level ensure some supply chain which they believe will help them in future and not rely on single source. But also understand a very important aspect. Any nation will import because you want to import deflation. If you would have been able to manufacture that at the same price, then you would have already been manufacturing it. So the fact that you need assistance from developed nations or cheaper cost destination is because you cannot justify that production cost in your own nation. So in that context, and when the world wants to create an alternative supply chain, I always maintain that India offers this triple benefits of size, scale, and skill. Now, any country which has to look at from a size, scale, and skill perspective, India by default becomes the alternate choice. You would have all heard about Bangladesh plus one is the new theme which is emerging, right? So I think even when there is insourcing or nationalism at play, the fact we are barely 1.8% market share, and you have seen China being more than 12, 13%, I think the simple logic here is even if India achieves this $1 trillion merchandise export target by 2030, it will still be barely 3% of the world export market. So for India, it's not going to be a constraint, and that's why when we have shown you again a slide which shows through various time frames, even when the world has gone through recession or not, India has only been gaining market share. Think about it from a different perspective. Even when the world was recovering from post-COVID, when the world economies were struggling, Indian exports still grew at 10% CAGR in last 5 years. With that context, if you're going and we're projecting the World Bank projections, if they hold true, the world is going to recover from here on, then a 15% CAGR story doesn't look too outlandish to us. So I think India is in a very, very sweet spot when you consider even the geopolitical situation how it's playing out.
Yes, yes. Perfect. Precise answer. Thank you so much. Yes. So moving to next, and probably this is the last question. What are the various sunrise sectors that are seeing positive policy impact?
So again, I think you just have to pick up where India is investing on the PLI front, right? I think clearly
Yes.
electronic manufacturing is an opportunity. And let me again put some number here. India today does about $108 billion of electronic manufacturing, EMS as you call it. It includes every electronic bit what you produce, from washing machines to television to laptops to even these mobile phones and everything. That number in a matter of next 5 years expected to be $500 billion from a base of $100 billion. So that's the kind of impetus PLI brings to just one single sector. And clearly, from about 30% export share on this $100 billion, it is expected to be or more than 40% export share on a basket of $500 billion. So electronic manufacturing clearly is one space we're very positive on. Clean tech. So you would have heard incrementally a lot of companies in India are kind of setting up their solar modules, solar cell manufacturing capabilities. Even if we talk about Siddharth touch upon conductor exports, where India has now already emerged as a big player. Incrementally, you talk about even from perspective of India setting up electrolyzer capacities, green hydrogen, fuel cell. So again, a clean tech part of the value chain is where India is investing, and we are very going to emerge on a sunrise bit of it. Even from perspective, if you think of a pure some of the sectors where we have always been there, but we never focus. So you would have heard small places or spaces like toys, right? A very small space, but the Prime Minister has been highlighting that India needs to build export capability there. It's not sunrise, but again, it's a very small fragment which can become much larger. Similarly, building material. India can easily cater to the world, and there was a very interesting data that India has already started eating into Italian tile market. While Italian tile is expected to be far, far superior in the initial days, but today the quality differential is barely 5%, and the price differential is still 4x the price of Italian marble of the tiles versus Indian tiles. So I think there are numerous sectors which can benefit from this whole policy initiative, and that's exactly one of the key theme of this portfolio.
Yes. Thank you, Abhishek, once again for brilliantly answering all our questions. So thank you. With this, I think we would like to end our Q&A session. And thank you so much once again to you and your team for this wonderful, insightful presentation. I'm sure all our partners and my sales team especially are feeling extremely convincing about this NFO. Looking forward to give you a great support in this, and we look forward for many such interaction ahead. Thank you once
Thank-
again to all our partners for patient listening. And thank you, our colleagues and team at HSBC, especially for continuous support. Thank you.
Thanks, Disha, and thanks everyone
Yes,
for logging in. Thanks, Siddharth, for taking us to the deck. As you mentioned, Disha, looking forward to further interactions. Thank you.
definitely. Thank you. Thank you so much once again, Abhishek and Siddharth, both of you. Thank you.
Thank you so much.
Yes, with this, we can conclude the session. Thank you.